Economic and financial developments and the outlook, of course, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25% and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, CPI headline inflation moderated to 4.9% in October from 7.4% in July. The moderation was observed in all components of CPI, namely food, fuel, and core, that is CPI excluding food and fuel. There has been broad-based easing in core inflation, which is indicative of successful disinflation through monetary policy actions. The near-term outlook, however, is masked by risks to food inflation, which might lead to an inflation uptick in November and possibly in December. This needs to be watched for second-round effects, if any. Domestic economic activity is holding up well as assessed in the previous MPC meetings and as reflected in the GDP growth for the second quarter of this year. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%, but remain highly alert and prepared to undertake appropriate policy actions as warranted. Monetary policy must continue to be actively disinflationary to ensure fuller transmission and anchoring of inflation expectations. The rate action so far is still working its way into the economy. Hence, the MPC decided to remain focused on withdrawal of accommodation to ensure that, as I have already stated, to ensure that inflation progressively aligns to the target while supporting growth. I would now like to provide an assessment of the growth and the inflation situation. First, let me focus on global growth in brief. The global economy continues to remain fragile. World trade is decelerating amidst global tide of protectionism. Despite significant restoration of global supply chains, factors like elevated debt levels, lingering geopolitical hostilities, and extreme weather conditions aggravate the risks to global growth and inflation outlook. Easing of inflation in advanced economies has led to expectations of an early end to the monetary policy tightening cycle, shoring up market sentiments. Sovereign bond yields are softening as markets are not factoring in any further rate hikes. Coming to domestic growth, economic activity in India exhibited buoyancy in the second quarter of this year, aided by strong domestic demand. GDP growth, as you would know, posted a robust growth of 7.6% in the second quarter of this year, that is 2023-24, driven largely by investment and government consumption. Turning to the third quarter, 2/3 of Rabi sowing has been completed despite late harvest of Kharif crops in some states. Manufacturing sector gained strength with easing input cost pressures and pickup in demand conditions. 8 core industries recorded healthy growth in October and continued their high growth since June this year. The Purchasing Managers Index, that is the PMI for manufacturing, rose in November. The services sector buoyancy has remained intact as reflected in the high frequency indicators which the Reserve Bank monitors. GST collections at rupees 1.68 lakh crore in November 2023 were also buoyant. Services PMI displayed healthy expansion in November. In my statement, there is a lot of data available, which I have put in the footnote. So those of you who are interested can have a look at the footnotes. The entire data in support of whatever I am saying is available in the footnotes. On the demand side, households' consumption is supported by durable urban demand and gradual turnaround in rural demand, as reflected in sales of fast-moving consumer goods, that is FMCG, and other indicators. Festival-related demand is also spurring household discretionary consumption in the third quarter, that is in the current quarter. Investment activity continues to be aided by buoyancy in public sector capex. This is also reflected in strong growth in steel consumption, cement production, and imports of capital goods. Capacity utilization in the manufacturing sector continues to remain above the long period average. Investments in fixed assets by listed private sector manufacturing companies also registered healthy growth in the first half of 23-24. Primarily driven by key industries such as petroleum, steel, chemicals, and cement. The total flow of resources to the commercial sector from banks and other sources at rupees 17.6 lakh crore during the current financial year so far is significantly higher than that of last year, which was at rupees 14.5 lakh crore. Despite weaknesses in external demand, both goods and services exports returned to positive territory during the month of October this year. Looking ahead, private consumption should gain support from gradual improvement in rural demand, strengthening of manufacturing activity, and continued buoyancy in services. The healthy twin balance sheets of banks and corporates, high capacity utilization, continuing business optimism, and government's thrust on infrastructure spending should propel private sector capex. The drag from